Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. This week on the podcast, I shall be talking to two guests. The first of them, Tim Levene, who is the CEO of Augmentum Fintech, ticker AUGM, a specialist investment trust that essentially invests in a venture capital style in UK and European fintech companies. Lots to talk about here. The impact of AI, whether the UK market is a suitable place for a venture capital investor such as this particular trust, and some of the positive progress that this trust has made despite trading at a significant discount, like so many others in the early stage or venture capital business. Following that, I shall be discussing a couple of other news announcements this week with Thomas McMahon, who's head of investment trust research at Kepler Partners. First time for him on the podcast, and we'll be talking about commercial property sector, following the announcement of the latest strategic review, this time from Balanced Commercial Property Trust, ticker BCPT, and also discussing the microcap sector and the interesting announcement from Aberforth Partners that they will be offering a rollover vehicle for those shareholders in its split capital trust, Aberforth Split Level Income Trust. Does this presage a revival of the split capital sector, or is it simply a response to a specific opportunity? All that will be discussed in a moment, but first, I'm recording this actually on a Friday rather than normally on Saturday morning, so I've only got the market data as of this morning, and therefore I'm going to keep it fairly brief. But overall, the general picture is that the markets have been relatively quiet this week. There have been gains for equity markets over the course of the week, but they've not been particularly significant as of the time of recording, except perhaps to point out that the China and the Asian markets, Hong Kong, have done particularly well this week, up something around 8% as I record this. There have been more modest gains for other indices. The all-share index up just short of 1% and the S&P 500 up 0.3%. Nasdaq a little better. That's been matched in the fixed interest markets by evidence of some gains in government bond prices. In other words, yields coming down a fraction after their recent spike. In the UK, gilt prices are up across the maturity spectrum, though not by significant margins, and the trend is similar in the US, with treasuries seeing yields edge a little lower. Consistent with this story of a relatively flat week is the evidence of oil, copper and gold prices all trending a little bit lower. So the market perhaps taking stock against the background of most recent announcement from the Federal Reserve saying that effectively the prospect of interest rate cuts this year have receded, and possibly only one this year now being penciled in by analysts, continuing this trend of evidence that inflation remains a little bit sticky on the measures preferred by the Federal Reserve at least, and it will be some time before the Fed seems willing to cut. Although it is still expected that in the UK and Europe, central banks will make a first or further cut in the coming months, so sooner than their US counterparts. It was local election week this week, and the early results suggest that the Conservatives will be losing a substantial number of seats, as is widely expected, with Labour making gains. Too early to read too much into these results as a guide to what will happen in the general election when it comes, but it's clear that the expected pattern is playing out so far. Turning to the investment trust sector, the investment trust index, representing some 190 of trusts that are in the FTSE All-Share, is trending upwards this week, up around 2.5% as I speak over the past 5 days, and the discount continuing to narrow a little, coming in now to a number beginning with 14, which is certainly some progress. Looking down the list of the best performers over the course of the week, again as I speak, the India Capital Growth Fund at top of the list, followed by JP Morgan China Growth and Income, both up around 8%, and a number of property trusts also making some positive gains, perhaps influenced by that news about the latest strategic review in the sector. There was some other news out from the property sector as well this week. China trusts generally doing well, up at least 4% over the course of the week, and there are also some gains for other Asian trusts. Hypnosis Songs is also up this week, following the news that Blackstone has come back with an improved offer, which has now been accepted by the board, following the bidding war between Blackstone and Concord, another fund backed by the private equity firm Apax. Turning to the other side of the ledger, there were declines for a number of debt trusts and also a mixed bag of infrastructure trusts and others. Turning to results, there were another 16 trusts I counted reporting annual results this week, far too many to go through in detail. Most of those for the calendar year 2023, but 3 of them for the 12-month period to the end of January. Just to highlight a few names, certainly some disappointing annual results from Phoenix Spray Deutschland, down 22% NAV total return last year. Digital 9, which we know has been in trouble, reported NAV total return of minus 23% for 2023. And Gresham House Energy Storage, another trust that has been much in the news, that reported NAV total return for last year of minus 12.9%. Of those reporting positive results, the 2 that stood out are both actually those reporting interim results, which obviously the last 9 months have been a much more positive period for investment trusts generally, and that is reflected in the fact that these latest interim results have come in showing double-digit gains in some cases. In particular, BlackRock Greater Europe, ticker BRGE, reporting a 18.6% NAV total return for the 6 months, with roughly double the return on its benchmark. And Keystone Positive Change, ticker KPC, the Baillie Gifford specialist trust that looks to invest in companies that are making a positive impact on the world. That reported a 10.7% NAV total return for its latest 6-month period, though that is still below the comparators that it uses to measure its performance. If you are interested in seeing all the results, then of course you will find them on the Moneymakers website if you are a subscriber to the Moneymakers Circle, our weekly subscription offering. There this week we have a profile of VH Global Sustainable Energy Opportunities, ticker GSEO, an interesting diversified renewable energy trust. And that will be followed over the coming weeks by profiles of Henderson High Income and CQS Natural Resources Growth and Income, among others. Also in the news, a couple of name changes. Aberdeen Private Equity Opportunities is changing its name to Patria Private Equity, ticker PPET, following the sale of Aberdeen's private equity business to Patria. River and Mercantile Microcap, ticker RMMC, which I shall be discussing in a moment, among other names in the UK microcap sector, is also going to change its name, though we don't yet know to what. That will be decided at AUGM on the 18th of June. In the property sector also, we learned that the proposed merger between Tritax Big Box and UK Commercial Property is going through following approval by their shareholders, and that despite the fact that the chairman of UK Commercial Property abstained from voting on the grounds that the trust had not done enough to explore alternative options for its future. That deal will take effect on the 16th of May. And finally, as manager change, news from European ASIT, ticker EAT, that Sam Kosh is being replaced as the lead manager of that trust by Mine Tezgul. And over at Global Smaller Companies Trust, ticker GSCT, it's been confirmed that Nish Patel is taking over as lead manager following the planned retirement of its long-serving existing manager, Peter Ewins. So this week I had an opportunity to catch up with Tim Levene, who is the CEO of Augmentum Fintech, listed investment trust which came to the market in 2018. So you've now clocked up more than 5 years in the market, but it's been a frustrating last couple of years. We spoke about a year ago, and since then, basically the share price is pretty much where it was, and it's been quite frustrating because I think you're going to be saying that you've made some progress with the underlying investments you've got.
Yeah, I think that's right. And I think when we spoke a year ago, we talked about not being able to control market sentiment. I think it's fair to say that market sentiment remains challenged. I've just come from the Peel Hunt annual FinTech conference where there was more enthusiasm than this time last year. I think the perception in the room was that we're seeing green shoots, that there's some strong underlying growth. I think what we haven't seen is that kind of flow through to the market more generally. I think there are certain things that we can control and certain things that we can't. As much as I would love to be able to control the London market and share price movements, that's a little bit more challenging when you look at our peer set equally suffering from the same frustrations. I think when people invest in Augmentum and other, venture capital funds, it is a long-term, hopefully calculated bet. And we, over the last 5 years, have been building a diversified portfolio. I think if you go back to when we listed, we talked about giving investors real diversification, not just in the fintech companies, but across Europe as well, and some of the subsectors. And I think we stand here today in 2024 with a portfolio of 25 companies, with a net asset value of just under £300 million, with a 35% discount. So I'd argue we still very much are on sale. And I think it presents a pretty compelling opportunity. But investors, both existing and prospective, often look at, well, what are the signs of maturity of the portfolio? Are you doing what you said you would do? And I think what's really important is to demonstrate, one, that when you're delivering realizations, which investors want to see, you're delivering them on a regular basis. I think in 6 years, we've delivered 6, and I think you're building a portfolio early on, so it takes some time for those exits to start to come through. But we look at the portfolio now, we look at the weight of the NAV, and we've got a number of still high growth, but quite mature businesses in regards of being profitable and being at real scale. And I think that's exciting that they don't require capital. They can be self-sustaining. Of course, there might be opportunities for M&A. There might be opportunities to invest further in international growth, or to continue to steal market share from market incumbents. So there might be good reasons to deploy more capital. But fundamentally, I look at the portfolio now and see that it's really well balanced, see it's well diversified across the subsectors of financial services, see it well diversified across Europe, but also starting to see some of those realizations flow through. And I think last year you asked about relative to mark, because everyone likes to talk about valuations. When you have exited businesses, have they been below or above where you hold it? And all our exits have been at or above where we hold it, and actually on average about 30% above where we hold. So I think that's really important because investors in this market want proof points, and you've got to continue to deliver them. So I guess that would be the accelerated summary of where we are today, recognizing some of the frustrations, but also quite excited about what's coming down the pipe in terms of opportunity, both within the portfolio, but also in terms of future investment opportunities as well, which I'm sure we'll touch on.
Okay, so if market conditions were slightly different, what would you be doing at this point? What would you say hoping to be doing at this stage if the market hadn't been the way it is? Would you have been hoping to go out there and raise more capital because there's so many opportunities out there? Or would you perhaps have realized more things by now of your maturing investments? What has been the actual hard impact of the discount remaining such a wide level and the derating we've seen over the whole sector, venture capital, growth capital, and so on in the last couple of years?
So I would say it's certainly the former rather than the latter. I think, of course, when you have a buoyant exit market, then more exit opportunities do present themselves. But at the same time, I think for us, we see that the strategy has passed for the fund to be bigger. So we could be investing more broadly. But at the same time, we are sitting on a reasonable amount of cash, and we have to make sure that we deploy that carefully as well. And I would say last year, the market was a little bit more muted, and where we did see opportunity, we were very conscious of making sure that we were comfortable with entry price and valuations. And actually, in part, we felt that those opportunities where we did have conviction, we weren't prepared to pay the entry price that was being asked. So I think we've had to retain that valuation discipline, even more so in the current market. I think you're right. We could be doing more. I think there are opportunities in this market to not just do primary, but also do some secondary. We think there might be some portfolios outside of the listed market. So there's quite a lot of temporary venture investors. We saw corporate venture vehicles. We saw sovereign wealth funds come into venture in 21 and 22. Many have exited. And I think there are some assets in there that one could look at quite carefully to pick up. But fundamentally, we need to make sure that we've got sufficient capital on the balance sheet to both support the existing portfolio and invest in what we think are the very best, the cream of the crop in terms of the next fintech opportunities for us. I think the exit market has been interesting. If you'd have asked me 18 months ago, I would have predicted a stronger exit market from an M&A point of view. We've seen some exits. Cushion was acquired by NatWest. business called Onfido, which was an AI platform onboarding customers in particular for the banking sector, for KYC, was acquired by a US business called Entrust. So there has been some M&A in the portfolio more broadly, but we still think that is a trend that you're going to continue to see over the coming couple of years as well. And I think the big kind of shift over the last 5 years is there is a very large segment of strategic buyers in the financial services space. Of course, there'd be the obvious ones, the banks, the insurers, the asset managers, but also the less obvious ones, some of the technology companies, or the likes of Entrust as well, that are looking to acquire IP and technological capabilities as well. So when you add up every exit that's happened over the last decade, you're talking well north of 90% have been through M&A, through strategics rather than IPO. So I think that is a trend that's absolutely going to continue. And there is some fabled large amounts of dry powder still sitting on the sidelines. I sat at dinner last week with somebody I know well who runs a very significant private equity fund and north of $10 billion in a new fund, and is still waiting to deploy the previous fund before they can really get to work. And I think they are keen to be able to put money to work in the market. And I wouldn't say I've been sitting on their hands, but at the same time are hungry for opportunities. So I do think this is a market that presents opportunity. I think we are going to see more public to privates as well, which isn't necessarily great for the London Stock Exchange, but there is a significant amount of value, as we saw with the deal with Darktrace last week. And I think there'll be more like that in the coming months and beyond.
So as far as the trust is concerned, the board has authorised a share buyback program, and you have bought back a number of shares, but you're also preserving quite a lot of cash. Is the bulk of that cash being kept, as you say, because you want to do follow-ons or you need to do follow-ons with your existing portfolio, or is it because you think you get better returns by putting that cash to work, particularly in this market, than you would by buying back your shares? How does that calculus work out in far as you're concerned?
100%. I mean, I think we're always looking at the best use of our cash. In an ideal world, you wouldn't have significant cash drag, and I think we're very conscious of that. The bulk of the capital that we have sitting on the balance sheet at the moment is very much earmarked for new opportunities rather than following into the existing portfolio. Of course, you need to make sure that you have firepower to support your existing portfolio and to be opportunistic as and when the opportunity presents itself. But fundamentally, we are seeing a pretty significant uptick in opportunities in the market. We've just done our Q1 review amongst the investment team, and relative to the second half of last year, deal flow, so pipeline opportunities, was up 63%. So we're seeing more and more opportunities. We remain very focused, very disciplined. There are a couple of opportunities that we did have conviction on, but again, the structure has to be right for us to deploy. So I think it's fair to say we expect to be more active this year than we were last year, but you can't necessarily define an exact timeline on when you're going to put that money to work. I think we feel that there's significant future opportunities in fintech, both this year and beyond. So we do want to make sure that we retain that firepower. And actually talking to many of our investors, they want to see us not just investing, but also growing the fund as well. I think they kind of fundamentally believe in the long-term nature of what we're doing and would rather not see us shrink the size of the trust, recognizing, though, that there comes a point sometimes where it's so accretive to buy back shares and it's a positive signal to the market. And we've certainly done that as and when it's appropriate.
At the moment, the discount, I think, is around 35% or a little bit north of that, maybe, but it has been wider than that. So is there sort of some level at which you either will be triggering more buybacks, or you will be thinking, okay, well, if we stick around 35%, that's still a level at which we can get better returns by investing the cash? I'm asking the same question in a different sort of roundabout way, I guess.
Yeah, no, I think it's a fair question. I mean, fundamentally, it's a decision for the PLC board, where the manager and the board need to make that decision. And I think they look very closely at that as well. I mean, personally, I believe that we absolutely should be able to deliver better returns. If we look at our rolling IRR, which is high teens, if we can be compounding that, our internal target is, an IRR of 20%, which will put you in the top decile of fund performers. So we believe that the opportunity is there to back exceptional high growth businesses that can deliver that outlier return. And that's very much what we want to do. But of course, you have to weigh up all the factors. Any discount, in my view, is frustrating.
So, of course, there's been a lot of conversation about the UK equity market and the relative valuations between the UK and the US. Do you think you're part of that process? We've seen, obviously, discounts have come in on some of the growth capital trusts, the Shihali and so on, but venture capital obviously is a slightly different vehicle. So do you think you're actually suffering from, if I can put it, the UK equity market disease, or is it actually just that you're in this particular sector and you've got this particular structure that's causing the problem? Would you be better off if you were listed in the US? Let's put it that way.
From our side, I would say there is a lot of scrutiny. There's a lot of commentary at the strength of the UK market. I think the UK market and the European markets, listed markets more generally, have struggled with tech assets in parts over the years. I think it's quite clear that the London market wants to see more tech IPOs, but at the same time, the companies need to fit a certain shape. So at scale, ideally profitable, and with a story that the market can easily understand and get behind. I think the appetite is there. Fundamentally, I think the London market more generally has been suffering from a lack of liquidity. I think we only need to point to UK pension funds that have seen their allocation shrink to low single digits, something like only 4% of UK pension funds have an allocation to the London markets, which, is a source of great frustration. And there are some positive initiatives that have been happening over the past few years to make the London markets more malleable, more flexible, more competitive. The biggest single needle mover is you need liquidity. I mean, the lifeblood of any exchange is a highly liquid market. And I think we are suffering from that lack of liquidity. And I think that is irrespective in the sector you're focusing on. When I look at Augmentum, I think we separate two things, which is there a valuation gap between UK venture and US venture? I think marginally so. I think European venture is priced at a discount, which is good, but not as big a discount as it was 10 years ago. And then, of course, we look at our underlying proposition where there remains a pretty healthy dose of cynicism across the private equity and venture capital sector when it comes to valuation. And I think there is a general view that valuations haven't yet reflected the public markets and as such require to be discounted accordingly and have an illiquidity discount as well, which I think is unfair because it's often been pretty indiscriminate and it hasn't given credit to those funds that have been more prudent with their valuation approach, have delivered multiple realizations well north of the holding value and demonstrate that there is a significant amount of future value in the portfolio. So I think for me, there are a number of factors that could make the London market more competitive, more material. But if you ask me, is there a silver bullet out there from a regulatory point of view? I would say probably not. But if you could push and encourage the UK pension funds to invest more in the domestic market, and remember, they do get a significant tax benefit. But if the vast majority of that capital is going overseas, most of which is just going to the US, then is it right that those that are investing more in the UK market receive the same tax incentive as those that don't? And I think that's certainly a question for both current and potential future government as well. So I think that's a really interesting space to watch. Certainly one where I'm watching and I would love to see a more vibrant London market, but I do worry because we are seeing more take privates and the market is shrinking. But hopefully we can stop the rot somewhat and allow the London market to thrive. And I think there's a lot of motivated minds and experienced people looking at that problem and, trying to find solutions. So hopefully with a lot of collective will and spirit and possibly some more constructive, actionable government policy, we'll be able to drive that forward.
Yeah, it's a tricky one, isn't it? I mean, there's an element of chicken and egg about it in the sense that if you were a pension fund and you'd say, well, I've been investing in America and I've done extraordinarily well over the last 10 years, so why would I invest more in the UK? It becomes a kind of self-fulfilling prophecy in a way, doesn't it? Which is unfortunate. But in terms of what you can do yourself, do you think that there is more you could do in terms of communication and marketing and so on? I mean, for example, I think you only put out a fact sheet once every quarter. Is there more you could do, or is it actually that you just be shouting into the wind, so to speak?
So it's a good question, and it's one we ask ourselves often. What more could we be doing to shine a light on the underlying portfolio, both to retail and institutional investors? I think the challenge with venture is it does take time. And what you can't do is on a monthly basis say, here's everything that's happened in the last 30 days, because it's not quite the same as perhaps more established businesses that are running on a quarterly reporting basis. I think there's a danger of running around trying to find news which tends to be a little bit more superficial. I think what we've tried to do is, when there is news to share, we've gone to the market to share that news. We do as much as we can in and around the results, where we do, and myself in particular, spend a lot of time both amongst the institutional investor community, but also the retail investor community, make ourselves available to share that story and speak to people like yourself to help get the message out. So I think we're always open to ideas. I think we've just put out our quarterly fact sheet. And again, when you're reporting twice yearly, there's only so much that you can put out in the quarterly fact sheet that's new. I think it's important to keep on people's radars and keep them motivating and remind them why they hold the stock and why there's significant potential ahead. And so I think we want to shine a light on the portfolio companies as well. We've got a number that we think are tracking really well and are getting to the point where people will start taking a closer look at them as they start to look at potential fundraising opportunities or exit opportunities at scale, whether that's IPO or something else as well. And I think that's where hopefully the portfolio will start to speak for itself in the next couple of years.
I mean, a year ago when we talked last on the podcast, we were a few months into what I might call AI euphoria. Is there anything you could do to sprinkle a little bit more AI dust around your portfolio? Remind us what kind of exposure you have in that, what is obviously quite a broad area, really, AI, and whether you've got plans to get further into that. Obviously, at the moment, we've still got huge amounts of very significant valuations put on anything that can justifiably claim it's involved in AI. Whether or not you think it's a bubble or not is another matter. What would your comment be on that?
Well, funny enough, I was asked this morning at the Peel Hunt Fintech conference that perhaps we should call ourselves Augmentum AI Fintech, because there's quite a lot of underlying AI in the portfolio. And I perhaps gave a cynical response of we could have called ourselves Augmentum Blockchain a couple of years ago when that was kind of top of the agenda. So I think fundamentally, a lot of our portfolio company have been leading or working with AI for many years. There's very little new in that regard. And I think indirectly investors are getting exposure to businesses that are working with some of the most sophisticated next generation AI technology. Of course, all the excitement over the past 18 to 24 months has been generative AI, large language models that everyone's getting excited about, and it's moving at a really fast pace. And I think there is plenty to be excited about. But for us, we continue to ensure that our portfolios are leading the charge in terms of how they're using and working with AI. I think from a pure play investment case, I think we have to be quite careful because valuations are inflated. I think we would argue that we're at the height of the hype cycle. So if you're familiar with the Gartner hype cycle, I'd probably have Gen AI at the absolute top at the moment. And if you look at the amount of capital that's going into it, I think what's pretty extraordinary over the last 12 months is to see how the technology incumbents have started to significantly invest. There's a bit of a land grab. So a year or so ago, they were accounting for, and I'm talking about Nvidia, Amazon, Microsoft, Google, Facebook, or Meta as they're now called, now account for about a third of all investment, whereas over a year ago it was low single digits. So there's been a real shift. So there is very significant land grab there in the market. And again, we are seeing a lot of interesting but overhyped and overvalued propositions now. And it's important for us as an investor to understand, where does the intersection with fintech happen? What are these pure play AI fintech propositions? And we are looking at a number of quite interesting businesses, but are still a little bit earlier. We'd like to see some runs on the board, and we'd like to see the industry start to play out a little bit more. So less hype and more substance. And I think that's important for us to see. So where can you see AI being put to use? I mean, we have some pure play AI propositions. We have a business in Switzerland using neural network AI for Forex trading. We had a business called Onfido, which I talked about just earlier, KYC facial recognition, that was just sold to Entrust using AI. And then a number of our businesses that are using what we would regard as AI co-pilots to really both streamline, whether it's on fraud, whether it's on customer service, and they've seen some very significant efficiency gains. So redeploying existing resource more effectively, in some cases AI is handling over 80% of customer queries, and in a way where the customer doesn't really know that they're engaging with an AI chatbot. These are much more sophisticated interactions than perhaps you would be looking at a couple of years ago. And what is fascinating from a feedback point of view is that the customer feedback is more positive when they're interacting with a AI sophisticated chatbot than with a human. And they don't necessarily know the difference between the two if it's all done on text. And I think that is where we're seeing real accelerated progress, significant sophistication, and allowing these businesses to frankly be more efficient. And when you are high tech, innovative, frankly, digital-led propositions, you are more comfortable working with new technologies. And I think many of our companies are at the forefront of that, which is exciting. Now, these businesses are also growing incredibly quickly in many respects. And so it's not about reducing jobs. It's about being able to then redeploy those assets elsewhere in the business to help kind of navigate that growth. So I think overall, there's still a lot to be excited about. I think if you want to look at an industry that is seeing a lot of innovation in the startup phase, I think look no closer than the wealth management space, which historically has been an industry beset by a lack of digitization, a lack of innovation, incumbents struggling to navigate the ever-changing face of the market. We only need to look at what's happening with St. James's Place, further scrutiny there. And I think there is a very significant opportunity in the wealth management space for further digital transformation. And I think you are going to see some very exciting businesses come out of the shadows over the next 2 to 3 years in that space, using AI really effectively to allow them to serve many more customers than they currently do at a much lower cost, offering a better outcome, lower fees with more transparency. And I think ultimately, if you're a customer, that's absolutely what you want. I think there's, of course, the elephant in the room of how do regulators in the financial services world get their head around AI, whether it's risk models, whether it's in making investment decisions. And I think that's still to be determined. But fundamentally, there are a significant cohort of companies that we would regard as next generation that are very much at the forefront, and we'll start to see them break through in the next couple of years. And I guess it's our job to make sure we pick the timing for those that we think have a great chance of really getting to scale.
When you talk about those companies, you're talking about picks and shovels rather than investing in the wealth managers themselves, as it were. Would that be right? The people making the tools to allow this greater efficiency?
I think it's both picks and shovels, those that are providing the next generation of tools to existing wealth management, asset management players to allow them to be more efficient, but also those that are building them to directly compete with the traditional incumbents as well. Now, we all know how hard it is to build from a standalone position a wealth management business. Acquiring assets does take time, but I think we are seeing a handful of businesses there that have made a strong start, but it is a slower journey. But you're absolutely right. There are a lot of picks and shovels companies out there that, frankly, many of them will be able to solve some of the big challenges that the incumbents are having. Now, the question is, as always, which of the incumbents are going to embrace and engage in what is going to be a transformative decade for their industry, who can get comfortable with some of the challenges that they're finding themselves in and are willing to adopt new technologies. And those that do, I think, will be the long-term winners. Those that continue to wait and sit it out, I think, will be challenged.
It's interesting. I would make the observation, I'm not sure whether you agree with it, that there was a lot of publicity about kind of robo-advisors and things a few years back, but there's been pretty slow penetration of the market. A lot of them have not really made the breakthroughs that they were hoping. But you're saying that or some kind of variant of that might yet still happen. You could see some quite significant players emerging.
Yes, you're right. I mean, we looked very closely a decade ago at the robo-advisors, and while we liked the problem that they were trying to solve, I think their challenges were twofold. One, acquiring customers back then was very expensive. The unit economics were pretty poor, and the cohort of customers that were comfortable to come onto a platform such as that weren't those that had material assets. And it is a long old journey to scale. I think roll forward 10 years, we are in a different position where there is a much bigger and frankly more significant cohort of digitally enabled customers that do have assets that would be more willing to become an adopter of a automated wealth manager, robo, or however you want to call it. But at the same time, the challenge still persists of it does take time. But I think the market has moved on. I think the addressable market size is much bigger. And I think the solutions available are much more plentiful, more transparent and more compelling. And also track record. There was a lack of track record 10 years ago, and you can't accelerate track record. And I think we've seen real progress in the last decade there as well. But I think you've got to kind of run both strategies. We would look at B2B, B2B2C, as well as B2C propositions in that space. But I would say it was a pretty disappointing cohort of companies that got to scale a decade ago in the robos. I mean, we can look to the US, the likes of Wealthfront Investment, and of course the UK. We can look to Nutmeg, which was acquired by JP Morgan. There haven't really been any others that have broken through, but I would hazard a calculated bet that we will see a fair few over the next 5 years break through relative to what we saw a decade ago.
Well, you might make one other comment perhaps, which is we don't know how the regulator will respond to all these issues. I would suspect the answer will be slowly. That may be unfair on the regulator, but that's an issue. And just on that final point on this sort of AI in wealth management, fund management, we have had a number of firms like Renaissance Technology and people like that, and the private hedge fund operations, which is so led to believe they've used sort of black box algorithms and so on. Do you think we might get sort of versions of those coming into the broader market as well? Have you ever looked in that area?
So I think the very best have remained black boxes and under the hood, because why would you share it if it was so good? There's a fantastic podcast on Renaissance Technologies, if you haven't heard it, on Acquired. And I would recommend, it's about 3 hours long, but it's a real history of how Renaissance has come to the extraordinary beast that it is today. And the returns are truly extraordinary. And there have been many that have tried to replicate. No one has quite managed to get close to their 40, 50-year track record after fees of 66% IRR. So fundamentally, I think those do stay a black box. But yes, I mean, I think that is both the opportunity and the threat with these enormous data sets, is how are people going to be using them? And of course, the more widely they're distributed, the edges can be slowly eroded. And I think therein lies the big question that, many are trying to answer as well. So I think there's kind of a lot to explore and discover. I don't have the answer to the question. I think we've seen AI neural networks in particular being used in certain markets, but their efficiency almost caps out at a certain size. So you can build successful models up until a certain level before you start to impact the market negatively and you start to erode your returns. I think the extraordinary thing about Renaissance was they continued to find ways to deploy more capital until they capped out, but they went into other products over time from where they started. And I think that's the measure of their success. But ultimately, the reason they haven't attracted external capital was because they didn't need it. They could only take a certain amount of capital, and the partners made so much money themselves that they didn't require, I think, after the 90s, any further external capital.
That's a nice position to be in, of course. Well, finally then, I wanted to give you a chance just to talk about the portfolio. If we look down that portfolio, so you've got sort of top 10 account for the bulk of the value. If you look at that top 10, perhaps I can ask you two questions, which are factual. One is, which of those do you think is nearest to a realization event in terms of maturity? And secondly, perhaps it's the one that's growing fastest, which is the one where you think has the sort of most potential gains embedded in it if things continue as they are now, which they never do, of course. I hate to do that.
Well, like your children, you don't have a favorite one, and you don't have a favorite one in your portfolio. But I think what I would point to investors, prospective investors, to look at the portfolio is there are 25 companies. As you rightly say, the top 10 account for high 70s in terms of NAV, but that's because we want to place a number of early bets as well, where we can double down on the handful that really break through. And what's been really pleasing over the last 2 or 3 years of those businesses that we backed 5, 6 years ago have really come through at scale. So we might have backed them when they were doing a handful of low single-digit £1 million of revenue, and now they're doing 100, 200, 300 million pounds of revenue, are profitable, whether that's Zopa Bank, whether that's iWalker, an SME lender, or Tide, a digital SME bank, or Grover, a consumer electronics rental platform in Germany. These are all businesses that have grown to real scale. And I think are ones where the market, not just the public market, but those substantive growth capital funds, those strategics are looking really closely at the journey they've been on. If I can point to one exciting business in the portfolio that is particularly pertinent at the moment, is a business called Tide, which is an SME digital banking platform. It launched in the UK several years ago. It was a real early challenger, had a few thousand early kind of SMEs on the platform, now has north of 600,000, so 10% market share in the UK, and has just launched in India and is about to launch in Germany as well. And in the last year has already acquired 250,000 small businesses in India as well. So a business that has been hugely successful here in the UK, is profitable in the UK, still got lots of growth opportunity, but also now can leverage the platform technology that it's built and really start to export what it has built and leverage that to help solve the problems, many pain points of SMEs that are common all over the world. And so I think it's a really important point to make is that we're building as an industry in the UK some fantastic fintechs, but these are UK fintechs often serving global markets. And so when you think about the Augmentum portfolio, yes, many of our portfolio companies are here established in the UK, but are also looking to build global businesses. And I think that's really exciting. So whereas Tide has demonstrated that it's been a huge success story here in the UK, and I think there's a long way to go, there's some very significant global opportunities as well that can hopefully deliver an even more significant return for us. So that's certainly one to watch for now. The other two to keep an eye on are the likes of Zopa Bank and iWalker as well, two businesses that have been around for a while, but have really kind of broken through in the last 12 to 18 months, and we think are doing some really exciting things. So yeah, watch this space over the next 12 to 18 months.
We'll certainly do that. So that was Tim Levene, who is the CEO working at Augmentum Fintech, the listed investment trust, and the only one in its particular sphere at the moment. So moving on then, I had the chance to have a conversation with Thomas McMahon, who is the head of investment trust research at Kepler Partners, the investment trust research firm. I thought it'd be a good idea to cover a number of themes that are of interest to us mutually, and in a couple of cases linked to more recent announcements. So the first of those would be the announcement this week from the Balanced Commercial Property Trust, ticker BCPT, which has effectively announced that it is undergoing a strategic review, which can be a prelude to a number of different outcomes. And it's a path through which other investment trusts have obviously been recently in some number. So first of all, Thomas, perhaps you could just remind us of what this trust has said, what it does, and then we'll go on to talk about what it might mean for the rest of the sector.
Yeah, so Balanced Commercial Property Trust is one of a relatively small number of diversified property trusts that are remaining in the sector. And it's been a difficult 5 or 10 years really for commercial property, at least in mainstream sectors. And the board has announced that it's considering its options as for the future of the company. The shares have been on a large discount for some considerable time. And it seems quite reasonable for them to be considering, therefore, whether this is what shareholders want. And clearly they'll be considering the mandates and whether they want to remain diversified in their approach, or whether one can assume they're considering whether they want to continue at all. And I think it's striking really that it's not alone in considering these options. We've seen a number of trusts merge or depart. Edison Property Company last year, UK Commercial Property Company looks likely to be merging itself away. And this, I think, really is indicative of the problems that we've seen in, firstly, the retail property sector, and then secondly, the office property sector. It's been year after year of disappointing performance, and the outlook is not particularly rosy. In the retail sector, obviously, we've had a very long shift in consumer tastes towards online retailing, which has reduced the amount of real estate necessary to sell goods in the high street. And then we've also seen in the office space really a large rise in home working, started before the pandemic, but really the pandemic has kicked it off. And so that really has been weighing on sentiment towards property. And then, of course, the interest rate environment brings all of that into sharp relief. When you can achieve 4.5%, 5% on a government bond, the yield you want to take the risks of investing in commercial property is going to be higher. And particularly when companies have taken out long-term debt to fund their dividends, when it looks likely that interest rates are going to stay higher for longer, it's quite reasonable for boards to consider whether their strategy would be viable if they have to re-gear at much higher rates. So that's really what's going on.
Yeah, so for all those reasons, it's been a tough 10 years for the diversified commercial property trusts. And of course, there was a number of people a few years ago who said, well, because of all the well-publicized problems in open-ended property funds, that this would be an opportunity for investment trusts that offer diversified exposure to commercial property. But it really hasn't quite worked out that way, has it? Partly for the reasons you've said, but also because there's now a question mark over whether this is a sort of feasible way for investors to gain diversification into property.
Yeah, I think it's certainly true that the open-ended fund structure is not appropriate for investment in commercial property and in illiquid assets more generally. There are obvious disadvantages. We saw this during the aftermath of the financial crisis, and there was a lot of talk about whether this structure should be allowed. And then it just sort of went away. I think the markets recovered a bit and everyone forgot about it. And then we had the Brexit referendum, which was a surprise to markets, and that led to another big drop in demand for UK commercial property. And again, we had the unsightly shuttering of various open-ended funds, investors unable to get their money back, and so on. And we've certainly seen over the last couple of years some of the larger open-ended property funds call it quits and leave the market. Of course, what's been going on parallel to this is the regulator has developed this new structure, the LTAF, the Long-Term Asset Fund, which is designed to be an open-ended, less liquid way of investing in less liquid assets. So the idea would be that you would agree to lock up your assets with limited ability to draw down, maybe at certain redemption points or after certain periods of time. So that solves some of the problem, arguably, but whether that structure will make it into the retail market is not really clear. Certainly LTAF's being launched for some institutional investors, some wholesale investors, and the structure is getting off the ground. I wouldn't say there's a rush for property LTAFs, and I think that goes back to what we were discussing earlier, the issues around investment in commercial property and whether that's attractive right now, which is maybe something we could talk about.
Yes, of course. I mean, when you get things moving to big discounts, that does create opportunities. Last year, some shareholders in some of the trusts that got bid for or merged did make some gains, unless it was an all-share merger. It doesn't always work as an all-share merger. But of course, we also had issues around, you mentioned UK commercial property, where the chairman has effectively been criticising his own board because that trust has not perhaps sought more partners than it could have done with the proposed tie-up that it has with Tritax Big Box. And we also saw Custodian REIT's attempt to merge with another trust falling through because of a number of reasons. So these things are not necessarily easy to pull off, are they?
No, and I would say I have some sympathy with the chairman in UK commercial property case in particular, because I think the sector as a whole struggled with the troubles with retail and then the troubles with the office market. But I think actually UKCM's manager, Will Fulton, had done a pretty good job of navigating those issues, certainly better than many of his peers. He seemed to cotton on to what was happening a bit earlier. And so the portfolio is actually quite well positioned right now. It's majority already in industrial property, which is the sector that has the strongest fundamental outlook in terms of demand, particularly in the southeast of England, where there's just not enough industrial property to serve the demands of everybody who wants to open a warehouse and distribution type establishment. And I think the chairman was pointing out that UK commercial property was offering something a bit different, and this is a very radical change of strategy. Now, I think one of the interesting things that UKCM did is that it started to fund some interesting alternative sectors. So there are a couple of student accommodation projects which they funded and then are now operational and generate a pretty attractive yield. And there are a number of these alternative subsectors that are really interesting. So student accommodation is one. There's strong demand for good student accommodation. And data centres is another area of great importance to how the economy is going. I do think, as a kind of overarching point, there's a real scope for a new, more interesting, diversified property proposition out there. I think maybe what the investment trust sector is struggling with is that the sort of legacy assets, that it's quite hard to unwind positions now after such a long time of these trends having been visible. In the case of Balanced Commercial Property Trust, it's got a very large holding in Oxford Street, St Christopher's Place, which is a really attractive asset, but a very large part of the portfolio, and it's kind of part of the deal with that. So any management of the portfolio, shift of the portfolio needs to be done around that. So maybe they're slightly restricted in what they can do in that respect. But I think it would be a real shame for the trust to disappear because I do think there's a very limited number of options out there for more diversified property exposure at the moment. Picton Property Income is one that's still around. It did seek to merge with UK Commercial Property a few months ago before UKCM found other options. And we assume that would have led to a larger diversified commercial property trust rather than the sector specialist trust, which it looks like UK Commercial Property is merging itself into. So, I think this is very understandable why the board is considering all its options. I think for investors, we would certainly lose some options if we saw the property sector retreat into some very narrow specialisms. But the investment trust sector is historically very flexible. I think that's one of the attractions, is it's very competitive. Somebody will come along with some new ideas and try and launch a trust if there's an attractive idea out there. So maybe we're just going through a period of creative destruction.
Well, it certainly feels like that. Just looking through the total returns you've got over 10 years, and they've been pretty modest, let's be honest, somewhere between 2 and 5% in the cases of the ones that have survived, and they're often the better ones. So it has been a problematic period. Let's move on then and talk about another announcement this week, which also perhaps has some interesting aspects to it. That's rather kind of niche in a way, and that is Aberforth Split Income Trust, ticker ASIT, which is one of the very few split-level investment trusts that are still surviving. They are proposing a rollover option for existing shareholders after the initial term of the life of this trust comes to an end in the summer this year. But they're also looking to launch a new vehicle as well, into which shareholders in this particular trust can roll over. So perhaps you could just explain for those listeners who don't remember what split-level investment trusts are, what they do, and what's happening here, why this is being proposed it will continue with a new vehicle.
The split capital structure is basically a way of adding gearing in to try and boost returns. So there are two share classes: the ordinary shares, which most investors would probably look to buy, and then zero dividend preference shares, or ZDPs, which, although they are technically equity, we can think of as debt. And basically the ZDPs have a fixed capital entitlement. So if there were 30 million at launch, let's say, then it would be agreed that you would get 40 million back at maturity. So there'll be a fixed life of 7 years, probably, based on what the past deal was. And then you can work out what the implied return is, and that is effectively your cost of debt. So for Aberforth Split Level Income, which was launched in 2017, when interest rates were low, that was about 3.5%. And the ZDPs don't receive any dividends. They just receive that fixed capital entitlement and nothing more. They can't do any better than that. And they can only do worse if there's a really catastrophic result for the company and the value falls below that base level, which is very unlikely. Ordinary shareholders, therefore, receive all the dividends. So let's say you had 70 or 80 million in equity and 20, 30 million in debt. You'd receive 1.2 to 1.3 times the yield on whatever the portfolio is invested in. And this is a small cap portfolio, and so the yield is traditionally quite low. So this structure offers you a way to get a good yield from the lower yielding part of the market and therefore diversify your income. And obviously there's also the potential to get 1.2, 1.3 times the returns over the lifetime of the trust because of the high level of gearing. So it's a very interesting structure. It's, as I said, effectively very highly geared, which brings risks. And I think in terms of Aberforth Split Level Income, it was very unlucky in when it launched, in that there was a huge growth run-up, which hurt the value strategy of the managers. And we started to see the big shift into large caps over small caps. It wasn't helpful. And then we had the pandemic. So the first couple of years weren't great for shareholders. But what we've seen in the last, let's say, 3 years is value outperforming. And as a result, ASIT has produced some really good results for investors. And the manager and the board are looking to roll over into a new vehicle that would have a very similar strategy. And arguably the outlook for that strategy now is better than it has been for a while.
So the strategy is similar to what Aberforth does in its smaller companies trust, broadly speaking. So you're getting a portfolio of UK value stocks, essentially. And Aberforth is the last of the so-called deep value investors in UK equities. And so you get the same strategy, but you get this gearing, as you say. And so therefore, if we're entering a period when smaller companies are going to do well, either in absolute or relative terms, then you will get additional return. While the holders of the ZDPs, the zero dividend preference shares, the return they get will depend very much on what the implied gross redemption yield is. We don't know what that is yet, though, do we? They haven't announced that. That'll be presumably made at the last moment. Well, we're back to an environment where gilts are trading between 4 and 5%, so it'll have to be quite a decent number, won't it, on the ZDPs?
Yeah, I think the GRY was 3.5% for ASIT. So that's based on where rates were in 2017. So from memory, maybe 1% or so. So it's pure speculation, isn't it? But maybe 7 or 8%, I suppose, is conceivable, which is probably slightly below long-term returns from UK small caps. So not a fanciful number at all, not an unachievable number. I think one interesting thing to bear in mind as well, that it works in two directions. So it's not only the case that the cost of debt will be higher, but also the yield. Just looking this morning, we can't get numbers for the new MIS index, unfortunately, which is where the managers will invest. But the yield for the MSCI UK small cap is around 3.5%. So that's pretty interesting in its own right. And not too long ago, it would have been an attractive income investment. But if you gear that up 1.3 or 1.4 times, you're getting close to 5% yield. So that's interesting. Well, you can say, okay, well, why would I want a 5% yield from small caps when I can get a 5% yield from US Treasuries or gilts? Well, you also get that return potential, and the UK market is undervalued. There's no question about that. It's cheap. Small caps are out of favour, and that it won't persist forever. It just won't, and we don't know what the cause will be for this to start to revert. But you already see it in takeovers of UK companies, that there's potential for really good returns just based on value. And I think that's something that's really been benefiting Aberforth over the last few years. As you said, they're one of the last remaining value managers out there, but this is their environment. They've been doing well, and it looks like that strategy will continue to be in much better place than it was in, let's say, 2016 to 2018, where it was growth over everything.
And do you think that they will therefore find support from new shareholders as well as those who opt for rollover for tax reasons or whatever reason that might be? Do you think there'll be enough sophisticated investors out there who will actually agree with your assessment that UK equities are cheap and value is due a good run and a bit of gearing wouldn't do any harm? Do you think that will prove to be popular? We haven't had any IPOs of any significance, obviously, in the last couple of years.
Well, we haven't had any IPOs, no, but I do think the mood has changed in the last few months. And I do think that funds that have a very clear, distinctive strategy and that can point to some success are issuing new shares. A few examples we saw last week. Ashoka India announced that it was seeking to place another 150 million shares. That's been a massive success story over the last few years, from 50 million at launch to almost 300 million now. And that's been in a period where everything has been on a discount. So there's appetite for a strategy that's doing well and it's got a good story. Rockwood Strategic, JP Morgan, Global Growth and Income, they've all been issuing shares. They've all been very successful in their niches and they're attracting capital. So I do think that if you've got the right strategy and a good story, I think you can raise money. I suspect that the manager and the board will have been sounding out existing shareholders, and I don't think they would have made this announcement unless they had some inkling that there was appetite. So I think that's something else to bear in mind. So predicting the future is hard, isn't it? But I think there will be appetite. I think this will get away, and I think it's quite an interesting proposition.
Do you think it's possible we'll see some other split-level trusts come back as well? Obviously, we know the history. There's been poor history way back in the early part of the century, which cast a damper over the whole sector for a long time. But in the old days, there were attractions for buying zero dividend preference shares as well as investing in the ordinary shares. Got a capital gain, which was important for tax reasons for people, and there was a lot of school fee planning and that kind of thing. They were popular for that purpose. Would you actually think that we're going to see any more? This one obviously has been around and I suppose just about proved its worth. The returns haven't been brilliant since it was launched, but you made the case for why it could be attractive now. Do you think anybody else will venture back into this snake pit, shall we say?
I'm not sure about that, no. I haven't noticed any interest from either manager or investor side. I think people tend to worry a bit about complexity, and we have a very regulated industry, lots of intermediaries in between the manager and the end investor. And people worry about whether they can explain something, and then they worry about gearing. I say the ability to gear up is one of the big benefits that closed-ended structure has. But if you look across the sectors, I wouldn't say it's heavily used. I mean, there's clearly a general reticence to go overboard with gearing, and good reasons for that. So I'm not sure that highly geared structures will see a great renaissance, no.
I would agree with you that that's probably the case. There's been a general reluctance of investment trusts to use gearing to significant degrees, even though it's often touted as one of the main advantages of the investment trust structure. Well, we'll have to see. Who knows? And of course, it's always difficult to launch or to persuade people to do things at a time when, in retrospect, in a few years' time, we'll find that maybe it would have been a good time to do it. But that's not how the market works at the moment, unfortunately. Let's briefly then talk about another sector, which I think you have done some research into, or you think it might be interesting, particularly against the kind of market environment you've been describing, which might benefit Aberforth. And that is the UK microcap sector. There were, I think, 3 trusts in this sector. Now there are only 2. We lost one last year. But those that remain, the best known ones, Miton manage one and River and Mercantile manage one. But they're both pretty small, as they have to be because of liquidity reasons. So looking up this morning, the Miton one has a market cap around 39 million and the River and Mercantile one is about 56 million. So these are pretty small in the current context where nobody apparently wants to own small market cap trusts. But do you think they still have a role to play for some investors?
I would also add Rockwood Strategic as well, which has fallen off your radar.
Including that one, but of course you're absolutely right.
70 or so million. And River and Mercantile, I mean, it's worth bearing in mind that they have that interesting structure whereby if they get to a certain size, they'll pay the capital back to investors. I think it's 150 million. So it may be 56 million now, but it's certainly been a lot larger. And Miton has been shrinking a bit thanks to buybacks and tender offer. I think it's been significant. I think if you want to look for value opportunities, something that's bombed out, something where there's relatively low risk and relatively high return, then I think microcaps is a really interesting place to be thinking about. There's good reasons why people have steered clear for a while. I suppose it's the last area where you would look as an investor. So if you're generally shifting into cash, as you probably have been, most of us have done at some point over the last few years, as rates have risen, maybe put that money into bonds or whatever, and then probably start by taking it out of the punchier stuff, and that's the last one to go back in. But as a result, I think microcaps is an area that has just fallen off the radar. Now, there's a lot of negativity around the UK market, the UK economy, but all these things are distinct, and it's important to remember that whether the LSE is struggling to attract launches or not, the UK has some absolutely fantastic companies which are highly desirable assets. And I think a great example was given last week, or maybe 2 weeks ago now, with Filtronic announcing a tie-up deal with SpaceX, a new contract with SpaceX that could see SpaceX become a major shareholder, issued a lot of warrants to SpaceX. And we saw a 50% jump in the share price in a day. And I think that is a real example of how you don't need to get the macro right to make really good returns in really deeply discounted assets. And I think, if you're looking at the UK for value, this is an area that it might be worth considering. I think if you want to get in early somewhere, this is maybe somewhere that nobody's looking at right now. But we're already seeing M&A and et cetera really starting to deliver some returns.
The interesting story about the microcap stocks is that if you look back over the last 7, 8, 9 or 10 years, as long as they've been around, they haven't been around for that long, most of them, but they had one glorious period in 21-22 in that sort of mad bull rush we had after the pandemic, and they did spectacularly well, but that's about the only time they have done well over the last few years. Is that the very nature of it? The volatility is always going to be there, and you've got to be quite smart about moving in and out, essentially, to capture the returns that might be there.
Well, yes and no. I think there's a lot of truth to that, but I think the managers who invest in this space, they can have quite punchy portfolios. So it depends a bit on who you're getting. Rockwood, as we discussed, has a very concentrated portfolio. That sort of portfolio is probably less likely to be dependent on general market conditions, probably less likely to be cyclical. It's going to be more about what's happening in those underlying companies. But yeah, in terms of a general recovery, as a market as a whole, it's probably going to prove very volatile. But I think you invest in something like that for stock selection, for alpha. In the same way UK smaller companies, if you look at the UK small cap indices of various types, the funds generally outperform over the long run and tend to outperform quite consistently. Obviously, the style element has interfered a little bit in the last couple of years because you don't really get the market when you buy small caps. Similarly with micro caps, you don't really get the market. You get some specific companies. I think that's partly the attraction. So the economic outlook is modest at best. We're not expecting a significant economic growth. But there are lots of companies that are developing new products, new technologies, which have huge growth ahead of them. And if they're very cheap, some strategic buyer will come along and take them out. And that's what we're seeing.
Yeah. I guess my thought on microcaps, just in broad general terms, they are terrific in theory because we know there are lots of companies out there, small companies, which aren't very well researched and so on. But there is always this liquidity issue and there are these big cycles you have to deal with as well. So you've got to be quite nimble to make money out of them, unless you just sort of buy them and forget about them for 20 years, in which case you might do okay. But it's an interesting thought, particularly at the current moment when there's so much talk about the UK market and whether or not it can move much higher from here. Very good. So that was Thomas McMahon, the head of investment trust research at Kepler Partners. Partners, talking to me about 3 themes that we think are of interest at the moment.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.